Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Msci Inc. Annual Report. Msci Inc. provides a wide range of businesses and services to the investment community worldwide. The company's index segment offers indexes for various financial products, including ETFs, mutual funds, annuities, futures, options, structured products, and over-the-counter derivatives. This segment also provides performance benchmarking, portfolio construction and rebalancing, and asset allocation. In addition to its index services, Msci Inc.'s analytics segment offers risk management, performance attribution, and portfolio management content and applications. The company's hedge platform allows investors to measure, evaluate, and monitor the risk of hedge fund investments. Furthermore, the ESG and climate segment provides products and services that help institutional investors understand how environmental, social, and governance (ESG) factors impact their portfolios. The All Other Private Assets segment offers real estate and infrastructure data, benchmarks, return analytics, climate assessments, and market insights to support investment decisions in private capital. The company's Private Capital Solutions segment provides tools for private asset investors to manage mission-critical workflows, including sourcing terms and conditions, evaluating operating performance, managing risk, and other activities supporting private capital investing. Overall, Msci Inc.'s businesses and services include index creation, analytics, ESG and climate analysis, real estate and infrastructure data, and private capital solutions. These offerings support the investment community in making informed decisions about their portfolios and investments. Unfortunately, I don't have access to the text you provided. However, I can still generate a general essay on what might cause an Msci Inc. stock price to remain stagnant over a year. The stock market is inherently unpredictable, and various factors can contribute to a company's stock price remaining unchanged for an extended period. One possible reason is a lack of significant news or events that would impact the company's financial performance or industry trends. This could be due to the company's stable operations, consistent revenue growth, or its position in a mature market with limited competition. Another factor could be the overall market conditions. If the broader market is experiencing a period of stagnation or volatility, it may not be surprising to see individual stocks like Msci Inc. remaining flat. Additionally, changes in investor sentiment, regulatory updates, or shifts in industry trends can also influence stock prices. In some cases, a company's stock price might remain stagnant due to internal factors such as poor management decisions, lack of innovation, or failure to adapt to changing market conditions. However, without specific information about Msci Inc., it is difficult to pinpoint the exact reason for its stagnant stock price over the past year. Msci Inc. market capitalization of $42 billion is materially smaller than most of its industry peers of roughly $69 billion. Msci Inc. trades at a higher price-to-earnings ratio of 36 times and a lower price-to-book ratio of -15.47 times relative within the industry. But when we look at the broader industry, much for its peers are also priced fairly or higher. This indicates an overall sector-level optimism, suggesting that investors are already valuing the industry with a forward premium for the industry, leaving limited opportunity to uncover undervalued stocks. As this company belongs to the financial data and stock exchanges industry, the liability ratio is less meaningful for valuation. Investors should instead focus on return on assets, ROA, and return on equity, ROE, to better assess the company intrinsic value. Liabilities have increased, while assets and equity have failed to keep pace or declined. This suggests the business is not growing and may be in decline, making it a highly unattractive investment from a risk perspective. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The company has consistently reduced its share count while revenue has grown, but declining assets and equity suggest buybacks may be taking precedence over reinvestment. The income statement shows that the company have been growing its revenue annually and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline in a company are often influenced by its partnerships and collaborations. One key factor is the presence of large clients such as BlackRock, which accounted for 10.8% of the company's consolidated operating revenues in 2025. The acquisition of companies like the Burgess Group LLC can also significantly impact revenue growth, as seen in 2023. Changes in segment names or structures may also influence revenue trends. For instance, the renaming of ESG and Climate to Sustainability and Climate in 2024 may have had an impact on revenue growth or decline. To better understand these dynamics, it is essential to analyze the specific services or products used by large clients like BlackRock and how acquisitions contribute to revenue growth. By examining these factors, companies can gain valuable insights into their partnerships and collaborations and make informed decisions to drive revenue growth or mitigate potential declines. The net income of the company experienced a mixed trend between 2023 and 2025. While it increased by $39,464,000 from 2023 to 2024, it decreased by 7.8% in 2025 compared to 2024. However, another report showed an increase of 9% in net income from 2024 to 2025. The decrease in net income from 2024 to 2025 was also attributed to a decline of $93,177,000. The profit margins of the company also underwent changes during this period. The operating margin decreased from 53.6% in 2024 to 54.7% in 2025, while it increased from 54.8% in 2023 to 53.6% in 2024. On the other hand, the net income margin decreased from 38.9% in 2024 to 38.4% in 2025, but increased from 45.6% in 2023 to 38.9% in 2024. The reasons behind these changes are attributed to various factors. The increase in interest rate risk and variable rate debt led to higher debt service obligations. Uncertainty due to macroeconomic conditions also played a role. Additionally, increases in compensation and benefits costs, non-compensation costs, and operating expenses contributed to the decline in net income and profit margins. The company's financial performance indicates a mixed picture when it comes to its operating cash flow. On one hand, the company generates negative operating cash flow from its leases, which amounts to $34,444,000 in 2025. This suggests that the company is experiencing difficulties in managing its lease obligations. However, despite this challenge, the company's overall net cash provided by operating activities remains positive for all 3 years, 2023, 2024, and 2025. This indicates that the company is generating sufficient cash from its core operations to offset the negative impact of its leases. Therefore, considering the overall picture, it appears that the company is indeed generating positive operating cash flow. The company's debt level and interest expenses have undergone significant changes over the past few years. According to the extracted summaries, long-term debt has increased from $4,510,816 in 2024 to $6,202,286 in 2025, a substantial rise of nearly 37%. This increase is also reflected in total liabilities, which rose from $6,385,436 in 2024 to $8,356,999 in 2025. Furthermore, the company's interest expenses have also seen a notable increase. Interest expense grew by 13.1% from 2024 to 2025, reaching $209,889,000 in 2025 compared to $185,500,000 in 2024. Additionally, senior notes outstanding as of December 31, 2025, stood at $6 billion aggregate, indicating a substantial increase in debt. Looking ahead, the company's total debt is projected to reach $1,200 million by 2030, up from $1 billion in 2029. These developments suggest that the company's financial situation has become more precarious, with increasing debt levels and interest expenses posing potential risks to its future stability. The performance of various segments and regions in the industry has been mixed, with some areas excelling while others struggled. On a positive note, the index segment performed well across multiple pages, with recurring subscriptions increasing by 8.6% and asset-based fees rising by 17.2%. The analytics segment also showed strong results, performing well on page 115. In contrast, several segments and regions underperformed. The private assets segment struggled to provide accurate data and market intelligence, while the real assets segment performed poorly overall. The indexes segment faced challenges in certain geographic regions and business sectors due to increased competition. Additionally, the analytics segment fell short against its competitors, and the sustainability and climate segment failed to keep pace with companies issuing sustainability and climate data. The non-recurring revenue of several segments also declined, including private assets, which saw a 33.9% drop, index with a 3.5% decrease, and sustainability and climate with a 3.2% decline. These results indicate that while some areas of the industry are thriving, others require improvement to stay competitive. Management is optimistic about the company's outlook, citing its position to benefit from emerging trends in the investment industry. The key driver of this optimism is a focus on client centricity, with a deep understanding of their needs. To capitalize on these trends, management has outlined several strategic initiatives. These initiatives include leveraging artificial intelligence, AI, to accelerate product innovation and expanding solutions for client customization. Additionally, the company aims to lead in sustainability and climate investment integration, as well as enhanced distribution and content-enabling technology. Management's growth strategy is centered around extending leadership in research-enhanced content, leading the enablement of sustainability and climate investment integration, and strengthening client relationships. The company continues to adapt to changing market conditions by investing in long-term initiatives and developing new products and services that meet emerging trends and client needs. This includes creating new tools and capabilities to support investors navigating increasing regulation and meeting new client demands through sustainability and climate considerations. Overall, management's focus is on adapting to change while driving growth and innovation. The company's financial activities have been multifaceted. One notable aspect is its dividend payments. The company has indeed paid dividends to its shareholders, as stated in the dividend payments section on page 77. This indicates a commitment to returning value to its investors. In addition to paying dividends, the company has also engaged in share buybacks. This strategy allows the company to reduce its outstanding shares and potentially boost earnings per share. The company's share buyback activities are documented across multiple pages, including page 38, page 49, and page 105. That concludes the financial summary for Msci Inc. Feel free to comment below, and I will be happy to answer them when possible.